In this video, we're diving into 20 key points that can guide you toward creating substantial wealth through the power of investing. Each point is a stepping stone on your journey to financial success, and together they form a roadmap for anyone looking to grow their wealth in the long term. Point number 1, start early and invest consistently. Time is your most valuable asset when it comes to investing. Begin as early as possible and invest regularly. The magic of compounding interest will work its wonders over time. Even small amounts invested consistently can grow into significant wealth. Point number 2, understand the power of compounding. Compounding is the 8th wonder of the world. Reinvest your profits to let your money work harder for you. This snowball effect can turn modest beginnings into substantial wealth over the years. Point number 3, set clear goals. Before you start investing, it's essential to have a clear understanding of your goals. Are you saving for retirement, a down payment on a house, or something else? Your investment strategy should align with your financial objectives. Point 4, live below your means and build an emergency fund. One of the golden rules of investing is to live below your means. Save as much as you can and build a robust emergency fund to cover unexpected expenses. Having a safety net provides peace of mind and lets spread your investments across different asset classes, such as stocks, bonds, and real estate. This way, if one investment underperforms, others can help cushion the blow. Point 6, invest in quality. When it comes to stocks, focus on buying quality companies that have a history of strong performance and a solid future outlook. Understand the businesses you're investing in. Look beyond just the stock price. Point 7, think long term. Avoid the temptation to try and time the market. Short-term fluctuations are normal and often unpredictable. Stay focused on your long-term goals and ride out any market volatility. Point 8, automate your investing. Use a systematic plan to invest consistently over time. This approach helps you buy low and sell high without making emotional decisions. It's one of the most effective ways to build wealth. Point 9, minimize costs. Keep your investment costs low to maximize your returns. Choose low-cost index funds and ETFs, which have historically delivered better results than actively managed funds. Point number 10, stay disciplined. Stick to your investment plan no matter what the market is doing. When markets crash, stay calm and keep investing. This disciplined approach can lead to significant wealth creation over time. Point number 11, be patient. Building wealth takes time. Don't expect to get rich quick. Patience is crucial. Let your investments grow and compound over the years. Point number 12, keep a well-balanced portfolio. Regularly review and rebalance your portfolio to make sure it still aligns with your goals and risk tolerance. As your circumstances change, your investment mix should adapt. Point number 13, know when to seek professional help. If you're unsure about certain aspects of investing, don't hesitate to seek guidance from a qualified financial advisor. A professional can provide personalized advice tailored to your needs. Point number 14, consider tax efficiency. Factor in taxes when making investment decisions. Tax-efficient investing strategies can help you keep more of what you earn and let your money grow further. Point number 15, don't chase hot stocks or trends. Avoid the temptation to invest in something just because it's popular. You think it will generate quick profits. Focus on solid fundamentals instead. Point number 16, invest in yourself. Your most valuable asset is often your human capital, your knowledge and skills. Invest in your own education and development. It will pay dividends in both your career and financial life. Point number 17, leverage the power of dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. It's a great strategy to mitigate risks associated with market volatility. Point number 80, learn to say no to unnecessary expenses. Resist the urge to keep up with the Joneses. By saying no to unnecessary expenses, you free up more of your income to invest and save. Point number 19, take advantage of employer-sponsored retirement plans. If your employer offers a retirement plan, especially one with a matching contribution. Take advantage of it. It's essentially free money. And finally, point number 20, never stop learning. The world of investing is constantly evolving. Stay curious, keep learning and adapting your strategies as needed. Continuous education is the key to long-term success. Now let's delve deeper into each of these points, expanding on their significance in your journey towards creating wealth through investing. Starting early is a game changer when it comes to investing. The earlier you begin, the more time your money has to grow. Time is your greatest ally in this journey. Even small amounts invested consistently can snowball into significant wealth over the years thanks to the power of compounding. For example, if you invest $50 a month at the age of 20, assuming an average annual return of 8%, you could have over $1 million by the time you're 65. Compounding is like the snowball rolling down the hill. It gathers momentum and size as it goes, much like your investments. When you reinvest your profits, you're adding to the snowball, making it bigger and bigger. Over time, this can turn your initial investments into substantial wealth. In the same way, without clear financial goals, your investments may not serve your needs effectively. Define your financial objectives. Are you saving for retirement, a home, or your children's education? Your investment strategy should align with your goals. This clarity will help you make better decisions about where to invest your money. Living below your means is a fundamental principle of financial management. It's about spending wisely and only on what you need. By doing so, you free up more of your income to invest and save. It might mean making some sacrifices now, but those sacrifices can lead to significant financial rewards in the future. Building an emergency fund is like having a safety net. It's a stash of cash that you set aside for unexpected expenses or emergencies. Having 3 to 6 months worth of living expenses in your emergency fund can prevent you from dipping into your investments during tough times. This safety net provides peace of mind and allows you to stay focused on your long-term financial goals. Diversification is all about spreading the risk. Imagine putting all your eggs in one basket and then dropping it. Not a good idea, right? That's why diversification is crucial. Instead of putting all your money into one stock or one type of investment, spread it across different asset classes. For example, invest in a mix of stocks, bonds, and real estate. This way, if one investment performs poorly, others might do well, helping to balance out the risk. Investing in quality means focusing on the long-term value and performance of an investment rather than just its short-term price. Take, for instance, a used car. You might find a cheap car that looks okay at first glance, but in the long run, it might require frequent and costly repairs. On the other hand, a slightly more expensive car that as well maintained could end up saving you money and headaches in the long run. The same principle applies to stocks. Investing in quality companies is like owning a reliable asset that can withstand market fluctuations and potentially appreciate over time. Thinking long-term is a powerful mindset when it comes to investing. It is about resisting the urge to make quick profits and instead focusing on building wealth over the long haul. Just like how you wouldn't judge a book by its cover, don't evaluate your investments based on short-term market swings. Stay committed to your investment strategy and be patient. Remember, Rome wasn't built in a day, and neither is substantial wealth. Automating your investing can make a huge difference. It's like setting up a system that works for you without you having to constantly monitor it. Imagine setting up an automatic transfer from your checking account to your investment account every month. This way, you remove the emotional aspect from investing. You invest consistently whether the market is going up, down, or sideways. Minimizing costs is about making your money work as efficiently as possible. Every dollar you spend on fees is a dollar you could be earning from your investments. Keep your investment costs low by choosing simple, low-cost index funds or ETF. These funds typically have lower fees compared to actively managed funds and have historically delivered solid returns. Staying disciplined is crucial when it comes to investing. It's the ability to stick to your plan even when things don't go as expected. The market might crash, your favorite stock might plummet, and that can be scary. But if you stay disciplined, you can turn those moments into opportunities. Remember, fear and greed should have no place in your investment decisions. Patience is the virtue of investing. It's about resisting the urge to jump from one investment to another in pursuit of quick gains. Don't rush your investments. Give them time to grow. Think of it like planting a tree. You don't expect fruit on the first day, do you? You nurture the tree, care for it, and over time it bears fruit. Keeping a well-balanced portfolio is like keeping your investments in check. Regularly review your portfolio to ensure it still aligns with your financial goals, risk tolerance, and time horizon. If your risk tolerance decreases, you might want to shift towards more conservative investments. Or if you have a longer time horizon, you could allocate more towards growth-oriented investments. Knowing when to seek professional help is a sign of wisdom, not weakness. You don't have to be an expert at everything. If you're unsure about certain aspects of investing, don't hesitate to reach out to a qualified financial advisor. A fresh perspective can sometimes be invaluable. Considering tax efficiency is a smart move. Taxes are a part of life, but you don't have to let them drain your investment returns. Not chasing hot stocks or trends is a mark of a disciplined investor. Stay grounded in your investment strategy and don't be swayed by hype. Do your research, focus on solid fundamentals, and resist the temptation to chase after the latest investment craze. Investing in yourself is one of the best investments you can make. Your knowledge, skills, and abilities can greatly impact your earning potential and career growth. Invest in your education, professional development, and personal growth. It's an investment that will pay dividends throughout your life. Leveraging the power of dollar cost averaging is a smart strategy. It involves investing a fixed amount of money at regular intervals, regardless of market conditions. This method helps reduce the impact of market volatility and allows you to buy more when prices are low and fewer when prices are high, ultimately lowering your average cost per share. Learning to say no to unnecessary expenses is a powerful tool. By resisting the urge to keep up with the Joneses or make impulsive purchases, you free up more of your resources to invest and save. Evaluate your expenses regularly and cut back on non-essential items to boost your savings rate. Taking advantage of employer-sponsored retirement plans, especially those with matching contributions, is like getting free money. It's an incredible benefit that many employers offer. Contribute at least enough to get the full match, as it's essentially a guaranteed return on your investment. Never stop learning. The world of investing is constantly evolving. Stay curious, keep learning, and be open to adjusting your strategies as needed. Continuous education is the cornerstone of long-term success in investing. Remember, the journey to creating wealth through investing is a marathon, not a sprint. Consistency, patience, and discipline are your greatest allies. Embrace the process, stay focused on your goals, and let your investments grow over time. If you found this video helpful, please give it a thumbs up and share it with your friends and family. And if you haven't already, please subscribe so you never miss out on our insightful videos. Thank you for watching, and until next time, happy investing.